Have you ever taken a trade that hurt so bad it wiped out weeks, if not months of gains, and you felt so defeated and so frustrated by it? Here's the scary part. Most traders think the problem is finding better entries. It's not. The real problem is usually position sizing and not understanding when to use leverage and when not to use leverage. In this video, I'm going to show you why one trade should never wipe out and destroy your account, much less gain after gain after gain. I'm going to show you how professional traders think about risk, about position size, and a rule that can keep you in the game long enough to become profitable. Because just like in Monopoly, in trading, if you run out of money, you can't keep going. Professional traders still take losses. I take losses all the time. The key is minimizing those losses and allowing the returns to be outsized so that you can make additional money. I'm going to show you how to do that in this video. Let's jump in. One trade should not wipe out all of your gains. In fact, we talk about this in some of our free events. I know we talk about this in our courses, but let me do this for a second. When it comes to trading, and I may put a video out on this, position size is critical. The position size in your trade is critical. The goal here is that every trade should be about roughly the same risk and reward. So when we call out a trade that's got a 10% stop loss and our average 3-year historic stop is about 4.7% on a share trade, you need to half size that position. Yeah, but if it works, then I'll only make half size reward. That's right. But it keeps your profits consistent. So at our Trade the Plan conference, which some of you guys have been to, others haven't, we actually give you our trade mirror spreadsheet, which Ramez built. Let me pull up last year's sheet. If you'll notice, look at my average trade size throughout the year. Do you see how consistent this is? Like here in April, a little bit bigger trade size, but in April that year, we actually took some ETFs with a 2% stop loss. So you could actually have a bigger risk. And so here on a $10,000 account, my average trading share position was 16%. Why? Because if we take, like, let's reverse engineer this for a second. So if we use $1,600 and we take a 4.5%, let's just call it 5% stop loss, you're only risking $800 per trade, right? So if our average stop is 4 to 5% at most, look at your average return. It's significantly higher. Right now in November, we only had a 2% return because we were 50-50. And so that's taken into consideration. But do you see what I'm saying here? So we're making more than we're losing, and our win rate's really high. So you should never have one of your trades wipe out so many of your losses. And even in futures, like here's our futures trade today. This was a 5-point trade that we took. I did it half size, good runner. Made $125. Yesterday, I lost $125. Now, that was $125 loss. That does not include the runner. These profits here only is a 1-to-1. We managed our option yesterday, so we had a 4.4 loss. We didn't call an option trade out today, but here's a 7.3 gain. Here's a 22% gain because we took 2 different trades here. What did we take on that day? Is that right? So we took one trade that was a 15% risk and another trade that was a 7.7% risk. These are the actual trades on the actual day, right? This is how I'm able to keep track of everything. So the purpose of me showing you this isn't to be like, oh, look how great we are. The purpose of me showing you all of this is for your own data to see, A, how do you trade? B, keep you safe. So honestly, I just got an email from a guy who's really frustrated. He took a big loss on something and he's real frustrated about it. And he's pointing the finger at me, but that one loss actually accounts for 64% of his entire losses on the year. So the question is, okay, if that's the case, why is this one trade wiping out so many? Did you position size too big because you just thought it was going to work? So like even an A+ setup for me, like if I have an A++++ setup, right, there's still a chance it doesn't work. And so because I understand the chance that it doesn't work, what do? You control that with your position size of your account. There's no world in which that should happen. Now, if you look at your 80-20 principle, right, where 80% of the work is done by 20% of the employees. Y'all know what I'm talking about? 80% of your gains come from 20% of your trades in this scenario. 80% of your losses come from 20% of your trades in this scenario. But anyway, all this being said, this individual could account, okay, well, 64% of all my losses came from one trade, right? Okay, well, why? If I can understand this component here, it helps me be better, which is why I'm showing you our data and saying, like, hey, our position size is basically 16% of the account. Full size trade. So if I'm doing a trade that's got a 10% risk, I'm not going to trade it full size. I'm going to trade it with 8% of the account instead of 16% of the account. That would be a full size trade because this allows my stop loss to be the exact same if I'm wrong. And so what I'm doing here is I'm protecting by position sizing properly, right? What this does is it protects your capital. So it protects your capital. More importantly, your emotions. Because the greatest asset and threat to your money are your emotions, period. You get emotional, man, this is going to work. I love this, etc. And now it doesn't. I'm angry and you're a bad guy. So a stop loss is there, yes, to protect capital. So when we look at a trade like a Palantir, we stopped out of Palantir, right? Again, I know some of you guys, you stopped out here to 126, right? Just assuming that we all got it at 134. I think it was lower, but you had the 6% stop loss, not a big deal. Personally, I got out down here about 7 or whatever, 7.9%, something like that. A little bit bigger stop than most of you guys, right? That's okay. Because I know that historically on the next trade, most likely I'll make it back and more. Now, where this gets hard for most people is when you start trading with leverage. What is that? That's like a 2x or 3x ETF, like a TSLL. That's a option trade, especially if it's directional because of theta decay or time decay. You can offset that with debit spreads a little or credit spreads. But even with credit spreads, you still have to be careful because your risk is typically you're risking 4 to make 1. You're like, oh, God, Mark, why would you ever take that trade? Because the way we teach you to set it up, you have an 82% chance of making money. And so you manage it based on a 1-to-1, not a 4-to-1. And so this is how we manage that particular trade. And so when you're trading with leverage here, that's where these numbers can get really skewed because I may take an option trade and make 30% and make 30% and make 30%. And then I'm in a trade that just goes sideways, goes sideways, goes sideways, goes sideways, turns up just a fuzz. I've got a lot of hope for this option, but I've been in this thing for 2 weeks completely sideways. And because I've been in it 2 weeks and I'm in a directional call option, I didn't give myself enough time to purchase. I'm actually down 15% on my cost basis. Then it drops and stops out 3 weeks later. Not only do I lose because I'm wrong on direction, I lose because of the time decay. So when you see us put in an option trade on our analyze tab, you always see me analyze numerous opportunities, right? A debit spread, a call, right? So like you'll have a directional spread. So a debit spread, you'll have a single leg call option or put option, and then we'll have our credit spreads. We have our stop loss, and every single time you'll see me go out in time, right? So like what's one that we set up recently? Was it Tesla? All right. So here's some call options that we set up at some point in Tesla, right? I don't know when, but every single time we set this up, you'll see me go out and say, okay, what if this goes to July 3rd? All right, well, what if this goes over to July 17th? Or what if this goes all the way to July 24th? And we look and analyze the stop loss on that every single time. The reason that we do that is so that if this scenario happens, you know exactly within probably a plus or minus probability of 5% what you're going to make or lose. So if I'm wrong on this trade and it takes 3 weeks for me to be wrong, I know within about 5% of what I'm going to lose. That is the power of the Analyze tab in Thinkorswim. And so even on an option, the goal is to structure your option trade in a way that you're not risking how much ever of your option. And if you look at this and you're like, man, if this stock does take, let's go to Meta. This is an awesome example. Y'all remember this trade? We got into this trade here on 5-6. That was the first call out on this trade, right? So we're in this trade 1, 2, 3, 4, 5. Real hopeful right here, right? It took some heat, didn't stop us out. This was our stop loss at 592, right? But if you're in an option, if you're in a direct, let's just look at this. We may just have a teaching session today. This, by the way, this is gold, what I'm giving you right now. This is what we're buying right here. We're going to move this up to $4,200 on the option. Okay. This is what we're buying on the call option. If I wait on this day on 512, watch this. I'm already down. It's just it. I'm not stopped out yet. I'm down $630. Right. Not stopped out at my low, at my stop. 2 days later at 514, I'm up $630. Hey, this looks great. Life's awesome, right? We move forward to 521, have not hit target, have not hit our stop. All we're doing is watching time erode. Now I'm back down $532. Let me see what this does. I don't want to do that. 520. I'm back down 600. I'm back down 600. We're waiting. Here we go back to 526. Now notice on 526 here, you are basically break even from our entry point. I'm down $252, and this is break even on the trade, right? Finally, the next day we hit our target, which was 640, and we're up $1,800, right? This is where you're getting out. That's where you're getting out at. You hit target. Well, if you didn't sell the whole thing, right? Let's go back to 6.2. Still not stopped out yet. If you're waiting on bigger targets, but now you're down 1,000, come back up to 6.4. Now you're back up 500. What am I showing you here? I'm just showing you like we're in a trade and it takes 2, 3, 4 weeks to develop. Then you make your bigger return, right? And so in an option trade, if you're trading this with a smaller account size, right? If you're trading this on your option with a smaller account size and you're seeing this plus or minus $600 swing and this is making you emotional, then you're not trading the right thing. And if you're like, well, my emotions aren't involved in that, that's okay. I'm just waiting for the trade, right? Then great, go for it. But the key to this is letting the stock work. Here's our entry. We literally held. Okay, this looks good. Held. Okay, this looks good. Some of you guys actually bought these 2 days because you didn't buy back here. And then 2 days later, you got rewarded, and it took the rest of us like 2 weeks, right? It took the rest of us 16 days. That's 3 weeks before we got rewarded on this. And then we ended up stopping out on this big blue bar here, right? On the gap lower, or it opened and dropped. And I was like, okay, if we drop, we're going to stop out. Boom, we stopped out. And then it moved up. We kind of regretted the stop. And now we're like, hey, we're really glad we stopped out of that. The point to this is position sizing appropriately in all of your trades, right? So BWXT, this looks great. We're making money on it. I'm really happy with it. Essentially, it wiped out Palantir and one more loss for me. You always want to structure trades so that one win nullifies 2 to 3 losers. You do not want one loser to nullify 2 to 3 winners. And this is how most people trade. Does this make sense? Okay. We talk about this in most of our courses numerous times in various ways. This is probably like the best 30-minute session I've done on it, exclusively on it. But we talk about this position size all the time, account management all the time, right? All right. So again, we're done with Palantir. Do you consider the total account value to get your percentage or go by cash available? I go by cash available. No, total account value, right? So if I'm trading a $10,000 account, $100,000 account, it doesn't matter. $1 million account, doesn't matter. If I'm trading a $10,000 account, we use 10 because it's super easy math, right? And my position size is 16%. So we'll call it $1,600. If I go off my available balance to trade, this only gives me 8,400 left, right? So now my next trade, if I use 16% of 84, I don't know what that math is. That's 13. So my next trade would be 13,444 if I go 16% off 84, which is actually only 13% of my account. You're like, well, Mark, if you do it this way, then you're only going to be in basically 5 trades at most. That's right. Rarely are we ever in more than 5 trades at one time anyway. Like right now, we're in 1 trade, and that's PWXT because Palantir stopped out, right? And so before that, we were in BWXT, Palantir, and TGB. Is it TGB? TGB, which hit target. And there was one more that hit target. IBRX. But I don't think we were in IBRX when we were in these. Right? So that's 4. I don't think we were in this one. So we were only in 3 trades at one time. Right? Now this one stopped. This hit our target. This hit target. This stopped. But these two, like TGB was a 22% winner on your runner. And it actually gapped into that. Western Alliance, yeah, we were in those, but Western Alliance we were in, but we weren't in at the same time, right? We got into Western Alliance here, I think 521. Because remember, I regretted not getting in back here. We got into this at like 521. We stopped out, or we took profits up here at 6.9. I think we stopped out on that hammer. All right. All that being said, rarely are we in 5 or 6 at a time. So you go off your account balance. That way you can keep it, you can keep your risk contained. And it's the same every single time. And so what happens is we fall in love with the stock. Like we'll see a stock and we're like, oh my gosh. This move in Tesla right here. Ooh, this looks great. Mark called this out. This looks great. I'm going to put 50% of my account on this one. And it works and you kill it. And you're like, awesome. And then we come back down and we get into this one and it's like, oh, I'm going to put 50% of my account on this one. We're going to go to the quarterly engulfing. And Mark told me to take profit, but it's going to go. I know it's going to go. And then you stop out and like, dude, I just lost X percent of 50% of my account. Well, why'd you have 50% of your account at risk? Well, I'm trying to make back all the losses that I've had. Quit being dumb. That's not the system. Does this make sense? Lauren Hamilton, if I could just take her picture and post it for y'all, she is the system. Small losses, bigger winners, consistency. Last year, she's my, and I know there's people that made a bigger percent than her. Like Otis killed it last year. I don't even know if he's in here. Otis made 70 something percent. New client comes in, brand new, knows nothing, 30% ROI because she did what we told her to. Hey, Lauren, you're in here, right? Or best loser wins. There's literally a trading book called The Best Loser Wins. right? Did you go through all of your courses, Lauren? Like if you finish the courses, okay. Do y'all think that going through the courses would probably be helpful to success? That's why they're there. Okay.